Join us to talk more about the new data, the economy, and the Fed meeting that kicks off today. Seth Carpenter, Global Chief Economist at Morgan Stanley, and Jim Grant, founder and editor of Grant's Interest Rate Observer. And good to have you both on set. So unlike when we're remote, I can throw out a question, and I don't have to say who I'm throwing it out to because you're both here. Do either of you think we're going to have rate cuts this year? Who wants to start? Jim, should we?
I think that a little modesty is appropriate because only 4 months ago there were going to be 6.
Yeah.
So I think that the future is perhaps not for the first time indeterminate. I think that an interesting question is whether we might have a hike.
Me too.
And I think that the zero probability assigned to that outcome only a few months ago I thought was excessive or inadequate. And I think that there is as much a chance of a hike as there is of 2 rate cuts, and perhaps as much as 1.
Well, that makes a big difference, doesn't it? I mean, we've got to get this straight, as a great anchor once said. So either 2 rate cuts or we might get a hike. I mean, the market, it's going to matter.
It's going to matter, and it's going to matter a lot. And I think Jim's point about how much repricing we've seen over the past 4 months is absolutely critical. And I suspect we're going to see same types of seismic shifts. I'll take the under in terms of Jim's forecast, but that's entirely predicated on our view of where inflation is going from here. I think the ECI number is really important, but if you spend a lot of time with the data, because you don't get invited to parties, then what comes out is usually it's the consumer price inflation that drives wages and ECI as opposed to the other direction. And so we're pretty convicted that inflation keeps coming down from here over the rest of this year, and that's why we're sort of leaning into there being probably even 3 cuts this year.
As we've seen number after number come in the last couple of months, have you wavered at all? Have any of them caused you to say maybe our thesis, or primary thing we're talking about isn't really happening?
Absolutely. I mean, the characterization of people being always confident but never right, that's not the place you want to be. And so I think you have to have humility, as Jim was saying. I think the tricky part, though, is if we break down the components of inflation, it sort of lets us stay in the same place. So housing inflation, it's been coming down for a year. It's still elevated, but it's coming down. And all of the available data on current rents right now that the BLS is going to use to spread out for the next 6, 9, and 12 months, that's clearly indicating that part is going to keep coming down. If we go to other services that Steve Leisman highlighted, one of the key components holding that up is auto insurance, which has been on this jag for a while because people had to negotiate with their regulators, and it's going to come off later this year, but it's not driven by the current state of the economy. So we feel pretty good that things are coming down, but it's uncomfortable.
What do you think, Jim?
I think that there is too much weight assigned to the rate of inflation and not enough to the level. So as William McChesney Martin said years and years ago, he said, you never recover the purchasing power you have lost to inflation. In times past, prices would rise, the average prices would fall, but now, in the modern age, they always go up. And this helps to explain the dichotomy between how people feel and how this kind of okay economy is presented statistically. And as recently as 1983, borrowing costs were part of the CPI. They are out of it. But people are paying a lot for mortgage rate, of course, but also for
borrowing costs got taken out. That makes 0 sense.
Yeah.
As if you don't need that too.
Yeah.
Well, they're out, but car payments, car loans are very costly now, and revolving credit ditto. So I think that the inflation problem is persistent and deep-rooted, not only in finance but also in culture. Inflation is a cultural phenomenon too. I think it's a something for nothing thing. Inflation, and we got a lot of that.
We do forget that though. So that someone on, only has so much money and got 4 or 5 kids, and looking back 2 or 3 years ago, and we saw what happened with the 40-year highs. If inflation drops to plus 2%, they're still at the supermarket, and the stuff that they were looking at last year, that they already were having trouble making ends meet, it's 2% higher than that. We forget that. So inflation when it comes down, it doesn't go down.
I completely agree. And I think this is a key tension between the perception about the economy and the reality of it.
Right.
Because people do look at the levels, and people who want to buy a house, young people, 25 to 35 years old, they look at the price and the mortgage together, and that's why I think a lot of you. However, we've been adding hundreds of thousands of jobs per month. We've been having a sub 4% unemployment rate for quarters. If we look in terms of, we were just talking about the employment cost index. So if we compare what's going on in inflation adjusted term for earnings, those are actually up for the bottom half of the income distribution relative to when this whole thing started. So it's true.
But now you're arguing for no cuts again because things are going so well that if inflation is the slightest bit of a question and we really haven't slowed a lot of those metrics, are we restrictive? And do cuts make sense?
Oh, but I think all the metrics that are important, right? So core PCE inflation had peaked at 6.5%. We're well below that.
Okay.
And if we're looking at the month-on-month rates, January was clearly outsized the upside.
But labor still, don't we need unemployment to go up before we feel like we're really making a dent?
That I don't think we really do. I don't think we need to see the kind of unemployment rate rises that historically we've seen, because this cycle coming out of COVID was just so different than those other cycles. I disagree fundamentally with people who said you need unemployment.
I think Jim might think differently.
We don't need it, but we have always had it in the way of getting inflation down. Financial conditions index, as measured by the Chicago Fed, have never deviated from very accommodative during the so-called tightening span. Money is easy, it's not tight. And I think that inflation is going to prove to be chronic, persistent, and rates will be higher for much, much, much longer.
I mean, you could get really negative, Jim, if what you're saying spirals.
The Fed insists on inflation. People forget that. People forget that the Fed targets a 2% devaluation of one's dollars every single year. That is what they aim for, and sometimes they overshoot.